Hello, this is Connie Belden, and we're going to continue on and talk about notes receivable. Accounts receivable, usually customers pay that off within 30 to 45 days max, and you generally don't charge them any interest. However, sometimes you may have a customer who's not able to pay off their sale on account to you within the allotted amount of time. And so therefore, they may come to you and ask to extend it to a notes receivable. And you may agree to do that. And in exchange, you're going to charge them interest and refer to it as interest revenue. So let's say, for example, that Joe charged $2,500 on account with us. And so we had initially recorded it as debit to account receivable, credit to sales. But now Joe has come and said, I can't pay you my account receivable. Can I have a 90-day extension on it? And you will say, certainly, but we are going to charge you 10% interest. So therefore, at the time that Joe takes the note out, you will debit notes receivable and credit account receivable just for the amount of the note itself. You will note that it will charge 10% interest, but you will charge that interest when he pays the note. Now remember, interest rates, such as 10%, are quoted for the entire year. Joe is just going to have this for 90 days. So the first thing you have to do then is calculate what will be the interest for 90 days. So the best way is on your calculator, take 90 and divide it by 360. I know there are 365 days in the year, and some books may use 365, but for our purposes, we're going to use 360. It's a more even number, and also they say to not count major holidays such as Christmas and Thanksgiving. So to get it as even as possible, take 90 divided by 360 first, the number of days divided by 360, times 2,500, the amount of the notes receivable, times 0.1 for 10%. So therefore, the interest for the 90 days is $62.50. So 90 days later, when Joe pays us, he owes us the $2,500 plus the interest revenue of $62.50. So Joe will pay us in cash $2,562.50. We'll credit notes receivable for $2,500 and credit interest revenue for $62.50. So all is well when Joe pays us. However, just because Joe took out a note receivable doesn't mean he's going to pay us on time. So a few different options can happen from that. We call it dishonored notes receivable when they don't pay it on time. So a couple of different things could happen. In this case, let's assume that our customer is John. Okay, we had originally had a sale on account for $1,000 to John, and then we moved it to a note receivable. Well, now John isn't able to pay his current note receivable. So one thing that can happen is John could come to us and say, hey, can I have an additional 30 days? And you could say, sure, for an additional 10% interest. Let's say that he had $25 worth of accrued interest at this point from the previous note, and then he's going to pay us that part in cash. So you end up actually doing a debit and a credit to note receivable. You debit note receivable for $1,000 representing the new note, and you credit note receivable for $1,000 representing the old note. So you're moving it from an old note to a new note. Since he paid you the interest revenue earned to date in cash, I debited cash for $25 and credited interest revenue for $25. Now keep in mind there will be additional interest for that next 30 days. So therefore, let's assume 30 days later that he does pay us the amount due plus the additional interest. So the additional interest is for an additional 30 days divided by 360 times 1,000 times 10%. So an additional $8.33 in interest. So when he does pay it, he pays cash of $1,008.33. Don't include that $25 again. He already paid it. Credit note receivable for $1,000. Credit interest revenue for $8.33. And all is paid up. So that's what would happen if a customer extends a note. However, what if that customer doesn't pay the notes receivable and doesn't come to us to extend the note? Well, we're probably going to do something to try and collect that more immediately then. So therefore, in a dishonored notes receivable, we want to put it back into accounts receivable, and we will try and collect it from there. And when we put it back into accounts receivable, you notice from my journal entry, we put it back in for the amount of the principal plus the interest earned to date. So what we did then, instead of debiting cash, since he didn't pay us, we debited accounts receivable for the principal plus the interest. And then we credited notes receivable, we credited interest revenue. Now, once we move it back into accounts receivable, one of two things can happen. Joe can pay it, and since it was once a notes receivable, we can charge additional interest on the accounts receivable, but that's only because it was once a note. Or we'll use the direct write-off method or allowance method to write off that accounts receivable. Let's assume that he does end up paying that, and he pays it 30 days later, and we're going to charge him another 8% interest. So now our principal amount is $1,025 because that's the amount we moved into accounts receivable. So 30 days divided by 360 at 8% times $1,025, an additional interest of $6.83. So we're recorded as a debit to cash. Now, in this case, the credit is to accounts receivable, not notes receivable, because remember we moved it back into accounts receivable, and then credited interest revenue for the additional interest. Now, if he doesn't pay it off, then we can write it off using either the allowance method or the direct write-off method. Okay. If he doesn't end up paying it off, okay, keep in mind that we cannot charge any additional interest. So if we write it off with the allowance method, we can include the previous interest on the note, but we can't charge any additional interest. In fact, we can't charge that $683. So what we do is we write it off by debiting allowance for doubtful accounts for $1,025 and crediting accounts receivable. Or if you're using the direct write-off method, the debit would be to bad debt expense, just like we saw earlier, instead of allowance for doubtful accounts, but it will still be a credit to accounts receivable. All of this is also available in your chapter notes, so I hope you use this as a guideline as you're writing journal entries in this chapter. Thank you very much.